Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why negotiations between Boeing and its striking workers are at an impasse.
Plus, we'll discuss why Honeywell International is planning to spin off its advanced materials division.
But first, we begin with some big news for Alphabet's Google.
This week, we heard that the U.S. DOJ is considering asking a federal judge to force Google to sell off parts of its business.
This would be a historic breakup of one of the world's biggest tech companies. For more, we were joined by Mandeep Singh, Bloomberg Intelligence Senior Tech Analyst.
We first asked Mandeep what he actually thinks will happen now with Google.
Well, so there are three big lawsuits out there against Google in the U.S. Two from DOJ. One is the monopoly lawsuit, which they lost, and that's where we are looking at remedies. The other one is also from DOJ against their ad tech business, where the DOJ is looking at their ad tech stack and how, they control all parts of the stack. The third one is from the different state attorney generals, again targeting their ad tech business. So when I look at everything that obviously regulators want to change with Google, the ad tech piece is the one which comes up over and over again, the fact that they control different parts of the ad stack. Now, in the monopoly lawsuit, they're talking about a forced breakup of the Chrome business or the Play Store business, Android business. I think it's very hard to take out, a single product from a company like Google and say this is a separate entity. It's just like it's all run on shared infrastructure. I can't imagine, doing that with Google and doing it successfully in the sense that Android can be a separate company. Maybe YouTube, but again with YouTube, it's run on that same infrastructure that search is run on. So how do you split that infrastructure? It's very hard to do it at the product level.
All right, here's some inside Bloomberg for you. You want to get really smart on a new piece of information that just hit the tape about a company. Type in the ticker, GOOGL for Google, hit equity, and then hit BICO, BICO for Bloomberg Intelligence Company Research, and you'll get what's called a recent event reaction. So I want to know immediately what Mandeep Singh thinks about this stuff. And what I read, I didn't expect to read. We see a breakup of Google's ad tech business as the most likely outcome for remedy in the company's monopoly case with the U.S. Justice Department. I thought what I would have read is, don't worry about it. But this has some teeth here. This is what you're kind of telling me.
Well, because they lost that first lawsuit at the DOJ, and the second one, the ad tech as well, it's very likely that the judge will rule against Google. Okay. So when you lose the cases, there has to be both behavior and structural remedy. And in the case of behavior remedy, they can make those payments to Apple anymore to be the default search or any other hardware maker. They'll have to open up Android to offer search screens so that you just don't have to use Chrome or Google search. You can use Bing search, for example. So choice screens is another behavior remedy. But the structural remedy in terms of a forced sale, I find it hard to believe that the DOJ will ask them to sell a product. It has to be more at the technology stack level.
So when we go to the ad tech stack, maybe that just dovetails with what you were saying. So what does control the ad tech stack mean when you're talking about Google?
So think of how an ad exchange works.
Okay.
You have the supply side, in terms of the publisher ad inventory, and then you have the demand side, the advertisers who are buying those ads. And then you have the exchange in the middle who is matching the supply and the demand side for ads. Google has products across the stack where they have a demand side platform, they have a supply side ad platform, they are an online exchange. And they've built it over the years because they made a few acquisitions. DoubleClick was the most notable one, where they acquired all the capabilities to really operate as an entity that knows everything when it comes to digital ads being sold in the marketplace. So they control that stack end to end. That's why when you compare Google's ad pricing to everyone else out there, they are far superior. One, they have the best targeting. The other is when you're operating a stack where you have the dominant product across the different pieces, you have a pricing advantage. And that's what, the regulators are saying, that this company controls pretty much everything in the ad stack.
But the advertisers themselves, they're not complaining.
Of course not. I mean, they're getting the ROI on their ad spend.
Like, who are they protecting?
This is a solution in search of a problem here, in my opinion, because I have competition in this market. I think I have competition. I mean, Google's huge, but so's Facebook. And now I got this little company out of Seattle called Amazon. They're a monstrous advertising player.
Yeah.
So where's the problem here?
So it all comes down to how you look at the market. If you look at the market the way you just described, where Meta is as formidable as Google and Amazon is a big third player, then yes, there is competition. But when you look at certain type of ads, whether it's on the desktop or the third-party ads that are going through Google Ad Exchange, these companies don't overlap. Like, remember, Meta is a walled garden. Even though it's big in terms of the digital ad advertising, it's its own walled garden. Amazon is its own walled garden. Google, so these companies have their own swim lanes. They are big in terms of the digital ad dollars, but they have their own swim lanes. They don't overlap. And that's the objection that I think regulators have.
Okay, so if they wound up moving around that ad tech stack and changing stuff up, what does that change look like, and how much money could then Google lose?
Well, so Google search obviously is a $200 billion run rate business, still the cash cow for Google.
That's unreal.
So that's where, the Google network piece, which is the ads that Google shows on third-party platforms. So one is Google showing ads on YouTube and their own search page. The other is Google showing ad on, let's say, a New York Times or some other publisher, because it's going through the Google Ad Exchange. That's the part that can be divested and it's a $32 billion run rate business within that $200 billion. That's the part that's not growing, but you could argue could be split up in a way where I think Google may be a smaller search ad business, but at the same time, that will appease the regulators because they're not controlling different parts of the ad stack.
Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
Earlier this year, French multi-billion-dollar brand Perrier came under scrutiny following the discovery of traces of fecal matter in one of the 7 wells used to source its mineral water. As a result, Perrier owner Nestlé said it had to close some of its wells in recent months.
Now the global water business is grappling with questions of sustainability. It's a subject of a Bloomberg Big Take story entitled Perrier Contamination Woes Add to $330 billion Sector's Hurdles.
For more, we were joined by one of the story's co-authors, Dasha Afanasieva, a Bloomberg Consumer Goods Reporter.
We first asked Dasha to break down her findings from the story.
So at the start of this year, Nestlé had to admit that it had been illegally filtering its mineral water in France, and in particular Perrier. And the reason why it's illegal is because mineral water under French law and actually European law, you shouldn't really do much stuff with it. It's supposed to be quite natural, whereas they were using charcoal filters and using UV filters. So they kind of come clean on that because there's a leaked report that forces them to. And then a few months later, there's another leaked report that says, there's fecal contaminants and pesticide contaminants and PFAS contaminants in the source, the Perrier source. And then after that, the other thing that happens is that they have to suspend a well because of contaminants. So it's all kind of wrapped up in trust issues and contaminants, but I'd like to highlight no food safety issues and no health issues.
So how does this evolve? Like, how does Perrier fix it? Like, how much it's going to cost? All that good stuff.
Yeah, Perrier found out back in 2020 that it was doing this. It was doing the legal filtering, but a new boss came in 2020 and realized they were doing this filtering and then brought in a program to modernize the plant so you wouldn't have to do it anymore. And that whole time they were in conversation with regulators, they say, to upgrade production and to also get everything shipshape. And they invested in modernizing the plant, something to the tune of 150 million euros. So they're saying now it's all good, nothing to see here. But that one well out of 7 is still shut. It's still suspended, I should say.
And this water, this is big business for France. Reading your article today, Dasha. The world's biggest bottled water exporting country, that'd be France, has fought hard to preserve the integrity and identity of its water with an eye on jobs and growth. The industry contributes 1 billion euros each year to France's external trade, and directly or indirectly employs about 38,000 people. So this is big business here. And I would think the brand value is what it's all about here. So they have to be careful, don't they?
I think it is about the brand value, and Perrier has had issues with this in the past, decades and decades ago, when there was a benzene contamination. So it did this massive recall, a global recall. So it has form, and this very product hinges on its premium status and on this idea that it's sort of pure and better than tap water. So you have to preserve that in the eye of the consumer, and maybe the individual consumer might not care how you're filtering it, but over time these sort of this trickle, if you will, of news definitely tarnishes or can tarnish the brand potentially.
How big is a business is this? Like, I got a soda stream at home, we bubble up our regular old New York tap water, but talk to me about the industry at large.
It's not a huge business for Nestle. For Nestle, it's only 3.5% of revenue, but the industry globally is around 306 billion and growing around 4% a year. So it is rather large, but as I say, not huge for Nestle.
So, I mean, I guess if you're thinking about a green economy, you ask a good question here in your article. Does it make ecological sense to transport millions of bottles of water, about 97% of them made from plastic, across the globe instead of sourcing it locally? How do the French think about that?
Well, the French would say our mineral water is super special and our amazing terroir. It's a bit like with wine. It comes from this incredible terroir, and we have the minerals, and we have this heritage of producing it. And that's the root of Perrier's marketing. But what Perrier's done to protect its future revenue streams is they've said, well, we'll have this whole other product called Maison Perrier that they can filter however much they want because it's not called mineral water, and it's now fronted by Emily in Paris, actor Lily Collins, and it still travels to the US. So even if you're making these, if you think the terroir, French terroir is so special, if you're filtering the water, you sort of think, well, why not just get the water in the US and filter it? Right. And the reason is marketing.
Our thanks to Dasha Afanasieva, Bloomberg Consumer Goods Reporter.
Coming up, we're going to look at sustainable aviation fuel and why it's important and how it's being used.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to the plane maker Boeing. This week, negotiations between Boeing and its striking workers broke down.
Boeing withdrew a contract offer to striking workers that would have given them a 30% raise over 4 years. The contract also included a boost to retirement benefits.
The impasse leaves Boeing with no clear path forward to overcome a months-long strike, and production remains shut down at its key commercial manufacturing base on the U.S. West Coast.
For more, we were joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We first asked George why he thinks Boeing withdrew its contract offer.
I think if you're the company, you have to make it look like there's a scarcity, I think, to whatever you offer, right? So that the employees are ready to jump the next time you give them, I think, a decent contract terms. But I don't know that it works here, right? So I think that it's interesting that they withdrew their offer, but I guess at the same time, I'm looking at the dock workers strike, and they just got an agreement for 60% over 6 years. It looks like 10% a year to me, if my math still works. Boeing folks, I think, rejected a contract that was 30% over 4 years. I think they're probably more highly skilled workers. No offense to the dock workers, but manufacturing airplanes a little more challenging, I think. So I think sort of the withdrawal is Boeing trying to make it feel scarce. I'm not sure that it works.
George, the more I think about this story, the more I read about this story, it just doesn't look good from a Boeing perspective in terms of leverage here. Boy, if I'm the union, if my guys can last a few more weeks, I can really inflict some pain here
Totally.
on this company here, which strengthens my position. How do the pros think about this negotiation between these two sides?
Yeah, I mean, I agree. I think it's really challenging. Like I just said, we've seen other increases in the marketplace for union labor higher than what this union's asking for. If you're Boeing, you just can't possibly replace 33,000 employees. There's just no way. And on top of it, again, they're skilled employees, right? So they're hand-making aircraft, right? And if you decided you were going to backfill and train some, you'd have to have people on hand to train the new people coming in to make an airplane well. It's impossible to replace them. And now I think we're in this game of chicken, right? Where, like we've talked about previously, Boeing's potentially going to have a downgrade. But look, I think the downgrade doesn't matter as much anyways, right? It's just a credit rating. You can get it back later on. This is the recovery of this company. Cash is dwindling. They have a lot of airplanes sitting in inventory. They need to get back to work. And I think if the workers can find a way to hold out, they can get a lot of what they've asked for.
So I understand that then Boeing has to front it, right? They have to act like they're also playing hardball. How long do you think they can really realistically sustain that?
That's the question, right? Can Boeing last longer than the workers? If the workers can hold out multiple months, I don't think the company can hold out multiple months. I don't think there's customers that aren't getting airplanes. Like Airbus isn't making a lot of hay out of this, right? They're having similar problems with their supply chains, so it's not like they can surge and take a bunch of market share away. But Boeing can't let this go on for 3 or 4 months, right? That would start to hurt, I think, their market share. I think you'd see customers get in the Airbus queue just thinking, look, I just don't know when Boeing's going to right this ship and really build airplanes in large numbers anytime soon. So I don't think they have a quarter. I don't think they have 3 months.
How far apart do you think the two sides are, and is there any smart money betting on timing?
So I don't know. I don't know what smart money's betting on right now, but look, it seems like when you pull back your contract and you stop talking, and the union goes to its corner and they're kind of irritated, it seems like something hasn't been set up well, right? To me, frankly, I think it's probably bad negotiating, right? Don't you always kind of try to engage to a certain degree? So to me, it feels like they're really far apart because of just the rhetoric I'm hearing in the press. But look, again, like a lot of things in life, some money can go a long way. It could put smiles back in people's faces, and so you could be surprised overnight if Boeing turns around and sweetens the offer and tries to get the deal done. But right now, it feels like they're a distance apart.
Well, aside from wages, obviously, which is a big one, what's another really big sticking point, or do you think it all just boils down to wages at this point?
I think a lot of it boils down to wages. We have heard that the union wants the pension back. I just can't believe they realistically think they're getting the pension back. But so I gotta believe they're looking for a sweetener on the 401k, some sort of added incentive there. And then the airplane. I haven't heard a lot of noise about negotiation about the next airplane. Again, if I were the union, especially if I was union leadership, the machinist leadership, I would want the next Boeing 737 successor built in the Pacific Northwest in plants that machinists are working at, because that's the lifeblood of your union, right? And that's the lifeblood of Boeing.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
Each week, we look at research from Bloomberg NEF, previously known as Bloomberg New Energy Finance. They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and the ag sector.
This week, we took a look at sustainable aviation fuel. For more, we were joined by Anna Davies, BNEF Head of Renewables Fuels.
We first asked Anna to explain what sustainable aviation fuel is and how it's being used.
What is sustainable aviation fuel? You use it exactly like that. You can throw it in your private jet and go, and it'll work just the same way.
Really?
It is, in its simplest form, molecularly pretty much identical to fossil jet fuel. The only difference is it doesn't come from fossil fuels. So mostly it comes at the moment from biofuels. So instead of having crude oil, you're using a bio oil. So something like soybean oil or used cooking oil, the leftover oils from your deep fryer.
Which would be the issue now, supply or demand, when it comes to SAF?
That is a very good question, because everybody says we need more, there's not enough produced, there's all this demand that we need to replace fossil jet. But we have seen both suppliers and actually airlines kind of roll back their targets. Right now, the problem is it's expensive and nobody is really willing to pay it. So we see buyers not quite willing or able to step in to take it. And as a result, we don't see suppliers able to secure financing to build their facilities. So
that's a chicken and the egg type of thing. How do you think you solve for that? Is that bringing the cost of production down? Is it trying to stimulate demand somehow?
So we anticipate the cost of production. At BNEF, we try and calculate and model out
you guys
production.
Are all about data.
Exactly. And we do not see the cost coming down to reach parity, really, like current jet fuel prices. It's always going to be a couple orders of magnitude above. So the real crux that's needed is policy. You need to have a policy push to either incentivize its uptake or force it. And we're seeing both of those policies developing.
Which basically what that means is that we have to subsidize the difference between SAF and regular jet fuel. And what the IRA did, it was really helpful in incentivizing the supply, but not the demand side of it. How close do you think that is right now?
So the IRA, the Inflation Reduction Act, does offer a tax credit for sustainable aviation fuel production, which does help to bridge that gap. There's still a lot of uncertainty as to what will qualify. You need to have a certain amount of types of feedstock in order to bring your actual emissions reduction down. That's a big issue in the market. It also is not only in place for a couple of years, which isn't going to help finance a 30-year facility. You see places like Europe taking the opposite approach, where they're just mandating blending in. So they're saying airlines and airports have to blend a certain amount, and that's going to ramp up over the next few years, sort it out, figure out the cost. And then you see places like Singapore, which is actually imposing a levy on airline tickets and saying, okay, we think SAF is going to cost this much in order to blend in. We have blending targets. We're just going to put an additional cost on airline tickets in order to cover the cost of SAF. I mean, we'll see what works.
In theory, that makes sense, right? Like you just pass it down to the consumer, but it does point out that any energy transition that you can do will eventually be then passed on to the consumer.
Consumer or taxpayer, yeah, probably.
Interesting. So what the U.S. airlines, all right, here I'm just reading some of your research here. So BNEF tracks airline net zero commitments and sustainable aviation fuel commitments. And currently 44 airlines, accounting for just under half of jet fuel consumed globally, have some SAF target, usually 10% by 2030.
Yeah.
Is that good enough?
Well, it's a target. So the question is, will they hit those targets?
Yeah, is it real?
Can they do that? And that's where we are starting to see some airlines procure SAF volumes, like United procures a lot. If you fly on, say, United out of San Francisco or LA, chances are there's some SAF in the tank.
Can they blend it?
They can blend it one for one. That's one of the beautiful things about sustainable aviation fuel.
But only that, you can just like easy replacement. Like you can just take the jet fuel out and put it back in, versus if you did a hydrogen plane or some other kind of plane.
Yeah, so you don't need new tanks or new aircrafts. You can blend it up to 50% currently is the regulatory.
Who produces this stuff?
It is currently produced in very small quantities. So right now, less than 1% of all jet fuel is sustainable aviation fuel. So we're talking very small volumes. It's produced, a lot of oil and gas companies and refiners are in on this space. So Neste, there's a company called World Energy and one called Montana Renewables that are producing at the moment. We're seeing P66 and Valero through their partnerships with Darling Ingredients.
Those are regular refiners.
So who does jet fuel today?
A lot of the refineries. So if you think of a refinery...
So you need to go talk to the refinery and say, you guys need to put out more...
And a lot of them are looking at it because a lot of the process at the moment is similar. You basically, instead of taking a crude oil, you take a bio oil, you put it through a refinery and get sustainable aviation fuel. So you can actually convert some existing oil refineries to take bio feedstocks and therefore make these biofuels. So we are seeing them active.
What about so a different question. How do you think this industry develops? And where does the strength develop?
So a lot of this is policy-led. We are starting to see a lot of policies support it, though, because aviation is one of the crux. You can make these types of sustainable fuels into a whole lot of things. You can make diesel molecules, you can make methanol molecules, petrochemicals. But aviation is the industry where there aren't any really good alternatives, especially if you're looking at like a 2050 SAF or net zero target. Because hydrogen aircraft, electric aircraft, it takes decades to get those off the ground. It takes decades for fleets to roll over. So if you really want to decarbonize aviation by 2050, you're going to need to decarbonize the fuel that they're currently using. So this is the area where we're seeing a lot of policy start to move. I've mentioned a few of them. We're starting to see some interest from different producers. We're starting to see a lot of investment going into this because everybody assumes the market will get there. So for instance, there's a different way of producing it where you take green hydrogen and captured carbon dioxide to make the fuel. That's popular because you don't have the food versus fuel issues of a biofuel. Just earlier this month, we saw Brookfield invest over $1 billion into one of these e-fuel facilities.
I need to go check out one of these. Where are these things? Are they just like in Texas and Louisiana, where all the other
California.
California.
A lot of the fuel is sold in California, and a lot of the old refineries are being converted there, but they are being produced everywhere. It depends on where the feedstock is, so you can see a lot of feedstock in the Midwest. A lot of the production's coming out there. We're starting to see e-fuels, which take green hydrogen. They need to be near cheap renewable energy. And so you'll see a lot of these.
And is this fuel as efficient as carbon, the regular fuel? Because I don't want to be 35,000 feet in the air and then engine light
You're
comes
as
out.
reliable is what you're
As
asking.
reliable,
Yeah,
thank you.
Yes, it produces Jet A spec fuel. There are questions if you had 100% SAF in your tank. Actually, a lot of the fossil jet fuels have some aromatics that end up in the jet fuel stream, and that actually helps with seals in the engine. So they're testing that out, but we don't have the quantities produced that you're anywhere near 100% these days. And in general, you could think of it as exactly the same as jet fuel.
Our thanks to Anna Davies, BNEF Head of Renewables Fuels.
Coming up, we look at Bloomberg Intelligence's list of 10 companies to watch in the fourth quarter.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Back in January, Bloomberg Intelligence came up with a list of 50 companies to watch in 2024, and now they're back with a list of 10 companies to watch specifically in the fourth quarter.
This is based on scenarios from our BI analyst who sorted through the barrel to find the good apples across sectors and regions.
For more, we were joined by Tim Craighead, Bloomberg Intelligence Global Chief Content Officer.
We first asked Tim to talk about the companies on the list.
Just to put context, this list of 10 are all focus ideas of ours. So companies where we have a high conviction view that we think is different from what the market thinks, and there's catalyst ahead. TrueLeave is a marijuana grower and distributor. They have stores, 70% of their stores are in Florida. And Florida has on the referendum this November the potential for legalization for recreational use. It would be a big deal for TrueLeave if this were to come through.
Yeah, I mean, Florida, huge market. And you know what I recognized when we went over to Ireland a couple weeks ago? They don't do the gummy thing over there. They don't have the weed thing.
Really?
They got to get on board there.
They just go to Amsterdam. Maybe that's it. They don't really need to. They can't compete.
I'll get Tim on that.
They just go to New York and then they come back to Ireland.
Exactly. Anta Sports, talk to us about that because I feel like I know they're an Asian company, so I'm assuming this has a China call to it.
It does, with an interesting twist. Anta is a sportswear company. They have a number of brands. I think when I've been on your show before, you may have seen that I've had an Arc'teryx vest on.
Well, you're like one of those. Tim is like an extreme biker, climber, hiker, all the stuff that I just have no interest in.
Good for you, Jim. I got nothing on that.
But
no,
Arc'teryx is owned by Anta, but the reason why Anta is on here is twofold. Number one, they do have a lot of things going on from the standpoint of driving their business with various brands. And the Olympics play through. We'll get results when they report next in terms of how good it's been. The China national team wore Anta Sports kit. But it's also a case you've seen lots of news about Adidas and Nike and how they're trying to get their inventory under control. That's making pricing better for sportswear generally, and we think that that's playing through into Anta Sports margins as a corollary.
That's interesting, especially when you compare it to, like, say, Nike. I understand they do different things, but still. You have Alstom on here. So this is basically straight up railroad stock. Why do you guys like this one?
Well, there's two things here. If you were to look at a 3-year, 5-year type chart, you would see that this company has gone through some problems. They had a big write-off and problem that was announced a year or so ago. The stock had collapsed. That's been settled, and they're on the right track, no pun intended, at this point. But importantly, there is a new European Union-wide signaling system that's coming into place that is meant to be reducing a lot of complication between different countries and whatnot. And it's an Alstom system. And in general, the train business is running pretty well. We think they're on a road for recovery.
One of the bigger market cap names on your list is Saudi National Bank. And I'll start with, I know nothing about Saudi National Bank, but it's 57 billion market cap. What's the story there?
Yeah, it's really interesting, and this is true for Saudi National Bank. It's also true for some others in the country. It's running contra to what most banks are experiencing. I think there's been lots of news and coverage, and certainly we've written about the pressure coming ahead for most banks with their net interest margins as interest rates start to decline. Their loan pricing comes down, and that's not great for margins. Saudi National Bank is an interesting case where, given the nature of how their loans reprice versus their deposits repricing, they actually stand to see over the course of the next 6 to 12 months net interest margin growth and expansion. And so it's running counter, given just simply the nature of their asset and liability mix, to normal bank profitability in the current cycle we're in. So it's a really unusual story.
Okay, we got like a minute. Can you do First Solar for me? Because for me, that's a TBD based on what happens with the Inflation Reduction Act here in the U.S. But you tell me.
It absolutely is. I mean, we all know that the election coming up is going to have a lot of implications for what happens from energy transition related spending and whatnot. That said, we're still going to see solar panels as a renewable energy source continue to grow. These guys are in the catbird seat, so to speak, from the standpoint of they have a dominant position in the US. They've got good technology, even though the Chinese producers are bigger and lower cost with arguably better technology. There's way too many restrictions for China product to come into the States. And so First Solar is not, you wouldn't say it's in a monopoly position, but it's a very advantaged position. And almost regardless of what happens with the IRA, we think that they've got wind at their back for better order growth going ahead.
Our thanks to Tim Craighead, Bloomberg Intelligence Research Global Chief Content Officer.
We move next to news on Honeywell International. This week, we heard that Honeywell plans to spin off its advanced materials division.
It's the latest move by the industrial conglomerate to reshape its portfolio, and this comes as there have been calls for the company to spin off or trim its holdings.
For more, we were joined by Karen Ubelhart, Bloomberg Intelligence Senior Industrials Analyst.
We first asked Karen if this potential spin-off is a big enough catalyst for Honeywell.
It's big enough to count. I don't think it's big enough to, settle the question of should they have more focus. They've tried on the M&A side, which they were criticized for not doing any deals despite sitting on $10 to $12 billion in cash for a very long time. They've done 4 deals under the new CEO, one of them rather large. It's not moving the needle because acquisitions take time to tell you if they're successful or not, right? But they haven't done anything on the divestiture side since 2016 when they did the 2 spinoffs. So they were looking to do something. I thought they'd do something, but it had to be big. Is this big enough? No. But he did signal at a conference recently that if they didn't do something material by the end of this year, he'd be disappointed. So we knew something was coming. I don't know if this is enough.
So, I mean, Alex, no one on Global Wall Street has more experience with divestitures than Karen Ubelhart. She's been covering these industrial companies for decades, and they're always buying something or selling something. And the best example is GE. And it seems like GE has gotten to a spot where the market likes where they are and how they're positioned. Is Honeywell, Karen, trying to do something like GE?
To be fair, GE took a real long time.
Generation.
I said, don't bet against Larry, but it took a very long time for it to work. So I don't think.
So is Honeywell in the same kind of strategy?
They have very good businesses. They were never in the trouble that GE was in, and they're one of the most profitable companies in the group. The problem is there's a lack of catalyst, number one, and number two, as we know, these things go in waves and people want focus now. I've said over the cycles, they break them all up, they put them back together. They break them all up. We're in the break them all up now. And a lot of the companies have really pared down, like the HVAC companies, for example. So people want something big. And the other point I'd say is they have, mediocre organic growth for a while now, but they always delivered on earnings. They missed for the first time in the last quarter, and that stock blew up because they don't miss. So, it's been an underperformer now on any time period you want to look, 1, 3, 5 years. And he's frustrated, you can tell. But I think there has to be something more.
What is Honeywell now? So if I was to go to you and be like, what do they do? What would be your answer?
The biggest business is aerospace. Very well positioned there. Very good business, good long-term outlook. Building automation is a second one. It's the rest of the three are smaller, and that's a decent business. I don't think it's a particularly high grower, and they did a big acquisition there. The other third big business is automation, and it's factory industrial automation, process automation. It's warehouse automation, which has not worked out that well so far, and a few other bits and pieces. And the third piece is what remains of the chemical business, which is a catalyst business called UOP.
So, Karen, I know from reading your research and talking to you over the years, you got to get the right CEO in there to really get things done, because these are big lumbering companies. The CEO now, Vimal Kapur, has been in the role for a little more than a year, but he's been at Honeywell for a long time. What's the street feeling about him? Is he the guy who, like Larry Culp, can get things done?
I think people were surprised, but took the change positively, because people had been frustrated that they sat on so much cash and probably didn't do anything with it, and people wanted bigger changes. So he took the first stab with all the acquisitions. I think operationally he does a great job. That's been the Honeywell story. I think we'll have to wait and see what else he does in the portfolio change. This is a decent sized move, but it's only 10% of the company. So I'd say wait and see on that.
When we've talked in the past, it's really been that warehouse part of the business, because it's so very, very, very early cyclical. And that's been causing a lot of short-term pain. For that business, have we hit a trough? Like, is there a recovery in sight, or to buy the CEO some time?
It sounds like by the order pattern that things have troughed. There was an overbuild in warehouses, as we know, right? And then it collapsed. And they only got 1 or 2 good years out of that deal before it collapsed. They've structurally fixed it. The margins are not bad. It looks like it's troughed, but I don't think we're expecting a really big rebound. But one thing I will say that the CEO said, it's 4% of the company now, only because it shrunk so much. But we spend a lot more time than 4% of the time. That's because it's still not fixed. It needs volume. I thought that was when they might think about doing something with, but again, not enough to move the needle, and I'm not sure they're convinced it doesn't have a good long-term story. We're convinced, I think, in general.
What do you think about the dividend yield here, Karen? Dividend, 2.2% dividend yield. I got, $6-7 billion of free cash flow every year. Should they be paying more of a dividend, or do you think most investors are happy with a 2.2% dividend yield?
I think that's okay. I think they'd rather have them use the cash in a more, active way, like either more buybacks or more deals. So the question is, will they do anything with it when they get rid of this business, which will dilute earnings? I think they'll probably take the route of buyback and grow into the dividend. It's not going to be like it was with Emerson years ago, when the dividend was way too large after they sold a third of the company. I think they'll keep the dividend. I don't know that they'll grow it.
Our thanks to Karen Ubelhart, Bloomberg Intelligence Senior Industries Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.